top three things in my notebook this morning. Number one, the VIX. Number two, oil. And number three, the 10-year bond yield. So first on volatility, it's not different this time, the friendly reminder there. Again, different would be if the VIX stayed below 10, which it never has. Again, never being at least the last 25 years of data. So again, the VIX up a full 14% off its June 18th closing low of 10.61. So again, we'll remain in the it's not different this time camp in that volatility is definitely going to surprise on the upside when the least amount of people are positioned for it. Now, the second point would be oil. Again, if you didn't know that the consumer is slowing via unlegislated inflation tax hikes, whether they come from Iraq or the Federal Reserve, they're the same thing. You still have to pay what it is that is at the pump, just FYI, just like you had to pay front-month natural gas prices in the first quarter. So, again, oil consumption tax up. Again, this morning you're seeing 106 hold on WTI, which is an important level of support, 105.71 just to be precise, on the momentum line, which definitely puts that 110 level that we've been looking for in WTI in play for the year to date. So it's going to be a very expensive summer for U.S. consumers as inflation continues to accelerate and the Fed continues to ignore it. Now, finally, the 10-year bond yield completely understands what we're talking about, not the least of which the Q1 GDP number down 2.9%. Down 2.9%? Everyone's going to say, well, we all knew this. Come on, like seriously. If we just want to lie to each other for the rest of the year, that's fine, but minus 2.9%. And they're making up the inflation number. If they use the real inflation number, I have to go through the math here, but GDP might have been like minus 4 or more percent. I mean, inflation slows real consumption growth. Consumption represents 71% of U.S. economic growth, and Hedgeye risk management rests its case. Those are your top three things.